Right now, Brent crude oil is just surging past $100 a barrel, and U.S. markets are hitting these 6-month lows.
Yeah, it looks like a classic economic slump, but, prices are actually climbing instead of dropping.
Exactly. So, welcome to your custom deep dive. Today, we're unpacking your sources on the global market outlook for the week of March 23rd, 2026.
And the overarching theme driving all this data right now is a stagflationary shock. Basically, slower economic growth colliding with rising inflation.
Right. And just looking objectively at the reports, this environment is largely driven by the current geopolitical conflict involving the U.S., Israel, and Iran.
We are focusing strictly on the market mechanics here, but, you simply cannot decouple those mechanics from the reality on the ground.
No, definitely not.
And the clearest place to see the tether is the energy market. Right now, the market's intense focus is entirely on the Strait of Hormuz.
Which is just a massive geographical choke point.
Exactly. Any prolonged closure there means a severe, physical strain on the entire global supply chain.
Think of the Strait of Hormuz like the global economy's main artery. If you apply pressure there, the heart, which is the global supply chain, essentially has its blood pressure spike instantly.
That is a great way to put it. It has to pump twice as hard and spend twice as much energy just to get basic goods where they need to go.
Right, and that extra effort, that friction, is the inflation we're seeing bleed into equities.
Yeah, because when oil hits that $100 mark, manufacturing and shipping costs just explode. That immediately eats into corporate profit margins across the board.
Which scares Wall Street.
Oh, absolutely. They see those shrinking margins and dump the stock, which is exactly why U.S. indices are bleeding out right now. Technical analysts are actually closely watching the S&P 500 hover around 6,500.
That's a critical psychological floor, right?
Yeah, it's the support level where buyers usually step in to stop the slide. If 6,500 breaks, well, it signals much deeper trouble.
But capital isn't just evaporating, right? It's hiding. The broader market is struggling, but energy and defense are booming.
Massive inflows there. And institutions are also stockpiling gold as a safe haven. It's trading near $4,567 an ounce right now.
Wow, even with those recent slam downs we saw.
Yep, even with the slam downs, where big players trigger sudden sell-offs to take quick profits, institutions are still aggressively accumulating physical defensive assets.
Wait, speaking of physical assets, though, everyone's been saying technology is driven by AI growth. Software doesn't get shipped on boats. Why are high energy costs starting to weigh down tech CapEx sentiment?
Well, you'd think they are insulated, but AI isn't just code floating in the ether. It requires massive, power-hungry data centers.
Oh, right. The electricity.
Exactly. High energy costs directly hit the bottom line of building and running that physical infrastructure.
So they have to pull back on capital expenditures.
Right. The physical electricity required to power those AI ambitions is suddenly, it's far too expensive.
Man, so if energy costs are driving everything up, central banks are in a really tricky position trying to manage this.
They are totally caught in a trap. The Fed is holding rates at 3.75%, and the Bank of Canada is sitting at 2.25%.
Yeah, and didn't Bank of Canada Governor Macklem say they plan to just look through this immediate energy spike?
He did, yeah. Unless it becomes broadened and persistent, they are incredibly hesitant to overreact to a supply shock.
But wait, if they just look through the energy inflation, aren't they basically just crossing their fingers that the geopolitical conflict resolves itself quickly?
Pretty much. They're walking a very thin tightrope between patience and negligence here, and this week's calendar data could easily force their hand.
What are the big events we're watching?
We have the UK CPI coming out on Wednesday, which is the official scorecard for consumer inflation there.
Okay.
And then that's followed by the US Consumer Sentiment Report on Friday.
Right. So if those reports show that everyday consumers are really feeling the pinch, central banks might have to abandon that waiting game.
Exactly. They'd be forced to turn hawkish and aggressively hike rates to cool things down.
It really shows how tightly interwoven geopolitics, energy costs, and corporate earnings are in this high oil environment.
Absolutely. Any company missing earnings because of rising input costs is going to be heavily punished by the market.
So here is a final provocative thought for you to mull over as you watch the boards this week. If central banks are forced to keep rates high while capital aggressively rotates only into defense and energy, well, how long can everyday consumer-driven businesses survive before the foundational structure of the stock market fundamentally changes entirely?